for those of you who don't know about this, I'm essentially going to do a little Excel exercise, valuation exercise, live. Feel free to, you know, imitate everything I'm doing. Uh, I'll share the screen briefly with you guys, and we are going to value a listed company called Red Velvet. So Red Velvet, ticker RDVT. That is what we are going to do. This is also going to be a recorded session, so we will publish this in a couple of days. Feel free to rewatch it or like pause it. But yeah, overall exercise on valuation and how I go about valuation. This will perhaps not be the most accurate in terms of, we're evaluating this company, and whatever price we get is the exact valuation. It's more about the methodology than it is about the end result. But the end result will also be fairly accurate. Yeah. Because the numbers are the numbers. The numbers do not lie. Let me share the screen with you guys. So we are going to share with you the Excel that we use for valuation. Let me know if you guys can see this. Beautiful. Again, this will be recorded, and therefore, if you miss any pointers, well, you can go back and look at the recording. Okay, so this is a fairly simple way of evaluating the company. The company has a track record that we will use essentially from 2019 up until present to understand what has been going on in the past. And then we will use a bunch of ratios and some assumptions that we will be diving into to essentially project 5 years into the future and extract both cash flows from these years and a terminal value. And we will obviously go through that math in a second. The two assumptions that we will also discuss are the WACC and the growth rate. These are numbers that we are including here. We won't include in detail the way you extract them because I think the detail is really unimportant here. What we will discuss, however, is getting to an approximate number that makes sense for you. In this case, for Red Velvet, but in general, we can be talking about any company. This again is applicable to every company out there. The more consolidated the company is, the easier it is to use this sort of methodology to get a value. We're looking at both value for the company, evaluation in terms of market cap, and the per share, in this case USD, because it is a US listed company. So yeah, we'll go into the financials shortly. This is, well, to be honest, all you need, or 90% of what you need to understand a company. You need a bunch of stuff from the income statement and the cash flow statement. To be honest, the only real pointers that you need here are these three. Free cash flow is extracted with capex, and the rest are important, but not as much for the sake of evaluation. If you understand these three in the income statement and cash flow statement, you are good to go. In terms of the balance sheet, the important ones here would be working capital and net debt. If you understand those two, you are also good to go. The rest is extra in order to calculate some like returns on assets or returns on invested capital and whatnot. So yeah, again, if you understand revenue, EBIT, operating cash flow, working capital, and net debt, these 5 items will define 90% of the work that you need to do in order to get to a proper valuation. Oh, I don't know if you can actually see the stuff that I'm highlighting, but let me make it yellow. That you do see. Okay, beautiful. So those 5 elements will define essentially the valuation. Okay, let's start at the beginning. So where the hell do I get the data from? The most optimal place to get the data technically is their filings. But in this case, we're going to skip that bit and use a filing aggregator, which will make things easier, particularly when it comes to extracting these, which, as you can see, are quarterly. When we're looking at quarterly data, we will essentially copy and paste the quarterly data here. We have an aggregation whereby, for 2019, we have a formula that aggregates, clicking here, aggregates everything for the year. And that will give us, like a last 12 months view. In this case, our last 12 months is 2025, but we would, include quarter one of 2026 if we had the results for the company in info. And you can just, keep on adding years here or adding quarters, and it will work perfectly. Okay. So once we have this, we want to go into our aggregator. And let me share that screen for you. Okay. Let me share the entire screen. And our aggregator will be this thing right here, which is ticker. Excuse me. Okay. From ticker, what we are going to do is search for the company. In this case, we've already searched for it. We would pick the ticker. And it would land us in the company overview. Again, using ticker just because it's the one I use, but you can be using Bloomberg or you can be using, well, there's a ton of these. Don't use FactSet though. Anything but FactSet. So we're looking at a company that overall, well, I'll give you a little brief of what they do. They are a technically cybersecurity company. They just aggregate data from a bunch of source points. It could be your credit cards, it can be cameras, it can be your work history, your criminal record. And what they do with all this data is they create a digital persona of yourself. So when it comes to, for example, loaning you money, a company that assesses credit or that is giving out the loan, it's usually that the person that's interested or the ultimate beneficiary is the one that's most interested. They will hire Red Violet and they will aggregate your persona in order to understand whether you are someone that's worth their while when it comes to giving out this loan. Whether you are going to default, whether you are going to pay back in a timely manner, whether you are essentially a trustworthy individual. That is what these guys are doing. They have two major software, which are the ID Core and Forewarn. Each one does its own thing, but they're all about creating a digital persona of yourself, creating a complete vision of who you are and what your actions will be like in the future. Sometimes for commercial purposes, other times for like criminal detection. You have a bunch of use cases for this, but it overall works out the same way for every single one, which is, ultimately you get an understanding of whether people will act in a certain way. With that in mind, and with that understood, obviously feel free to ask any questions. I will read those from time to time. Let me show you exactly what I'm doing. So I'll go into the quarterly data first off. The quarterly data will load, and we're looking at getting that since Q1 of 2019. Oopsie. Yes, we don't want the chart. Okay, I'll do unlock this. Okay, so it is telling me to use Morningstar for one of the historical data. Again, every time you do this, you really, really need to check your work. So even though you are importing this data from an aggregator, I would go to the source material, to the quarterly statements, and check perhaps not necessarily every single data point, but definitely check like every year. because you want this to be accurate. So I'm essentially copy and pasting. Coming here, I am. Why did I not copy? Let me select that again. Oh, wait a second. This is in millions. Let's use thousands. They will be more accurate. Here, boom, or not. This part of going live. Things are a bit slower. So again, quarterly in thousands and 2019 and warnings. Quarterly thousands 2019. Okay. 2019 first quarter. Oh, we want. Okay, so we will essentially copy this. This is the revenue track record, and we will paste that. Paste special, in this case, text. Okay, just note that there's going to be three colors here. There's going to be blue, black, and green. Each one means one thing. Blue means it's a manual input. Black means it's a formula or it's a title. And green means it's taking data from another another tab and sort of inputting it. It can be aggregating it. It can be just like giving you the direct output. Okay, that would be one. So we'll do the same for this. This is just extra data for us, which may or may not be useful, but it's sort of standard procedure as to what we want to get from in terms of data. Okay, G&A, text. R&D can be a thing or it can not. R&D is usually included in one of these. But in this case, we're just going to skip that part. We're going to go directly into EBIT. Okay. Now I'm skipping that line. EBIT. Boom. Now and then we will check that the columns match. Okay. Operating cash flow. Sometimes the operating cash flow, for example, with this aggregator is not that good. And so we would check the work. But since, again, this is just going through our methodology of evaluating a company, we're just going to take the data and assume everything is correct. For example, free cash flow is not something that we want to just defer. So instead of extracting the figure that it gives us, we will actually manually do this calculation, which is just the operating cash flows minus the capex here. So this should give us a figure. Okay. Okay, that is basically it. We won't go into acquisitions for this company just because it's not really there. We will, however, take on the depreciation, which is going to be useful later on. We just grab all of it. Okay. That is basically it for the income statement and cash flow statement. We are going to dive into the balance sheet. Let's see. balance sheet component, we are going to look at cash. In this case, cash and short-term investments are same. So cash, boom. There's usually a summation when it comes to debt because you need to sum the long-term and short-term debt. In this case, let me see, because there's usually a sum here. So I'm talking about long-term debt and current debt. There is neither. So beautiful. And I'm not sure why everything here is highlighted. We should totally not have this highlighted. Okay, so since debt and current debt are really not a thing, we'll just keep those empty because, again, what matters is the last few years. We can technically copy this and add it, which we will do for the sake of the exercise. So, for example, right here, we are going to add two little lines. You have to do this as for specific companies. So this is long-term debt, and this is short-term debt. We're also gonna push this in, and short-term debt is this here. This text here. So it does alter 2020 a bit, but that's pretty much it. We will sum these two and extend this up to the end of it. This also becomes a black column because it is a sum. It is not direct input. We will hide this because we don't actually need it. Okay. The calculation of net debt is just debt minus the cash. So if you have cash, your net debt will be negative. Beautiful. Net debt is one of those elements that we want. The second element that we want is receivables. Go to the beginning of this. So we want receivables. Again, you would have to check these on, with the accounts. Sometimes they're not exactly as it states here. These are payables, which is the summation of accounts payable, dividends, and other payables. And lastly, inventories, which should be in, it's a tech company, so it won't have inventories. Beautiful. So no inventories first. And with that, we will get the other figure that we want, which is working capital. Beautiful. Other than that, I'll just complete these four, which are useful for us. Total assets is just, or literally total assets is total assets. It does not go back. Oh, we did go back. Total assets. Beautiful. There. Boom. Current liabilities. Total current liabilities. This here. This is one of those companies, just as a side comment, that just has a bunch of assets in the form of intangible assets and also in the form of cash. So it essentially becomes de-risked on just a balance sheet, balance sheet manner. There's obviously other risks, but in terms of the balance sheet, just the fact that the total equity and the total assets are pretty much the same thing, well, it just de-risks the entire company. And shares outstanding, we will, again, you should check these figures, particularly on the diluted terms, because sometimes they're fairly inaccurate. A lot of these, particularly the tech companies, have a ton of options and warrants outstanding. And so you really, really need to check this. But in this case, we're just doing this for the sake of the exercise. So we will take the weighted diluted average share count. Not that I am taking the diluted one. Okay. This would be the one that you want. Excuse me. I took the non-diluted one. So I totally made a mistake here. Okay, there's not a diluted one. We would definitely have to check this because there's usually a basic share count and a diluted share count. We want to understand fully what these are. Technically, the diluted earnings per share and the basic earnings per share here, they are the same. And that means, or that usually means, that the share count and the diluted share count are pretty much the same. There are there's a little bit of a difference here. We would have to double check this. Okay. And now that we have those, I think we are golden. That is pretty much it. Let me stop sharing this and I'll share directly the window. That way we can remain focused on the data. Beautiful. Can you guys see my screen? Yeah? No? Maybe? No comments? Feel free to ask questions, by the way, as we go along. I may be going too fast or too slow for some of you. I'm more than happy to repeat any points. Again, this will be recorded. So you can just go through it step by step at your own pace. Probably Wednesday going forward. Okay. So once we have this, I'll just show you, but we're going to have an aggregation of it all. And the aggregation is as simple as, 2019 will be the last 4 quarters. So 30,000 or 30 million in this case is the figure that we're looking at. If you take the last 3, you will see that the sum is 30 million. Okay, with that in mind, we are extracting for the valuation the individual years. Let me see. So we are extracting these individual years just to perform the valuation later on. These are what matters, but having the full information is also very important. So that way you can contrast, LTM, last 12 months of, I don't know, in this case, we have return on capital employed. You can see that line. And when it comes to graphing this, well, it's just super, super useful. You'll see these later on, but you can see, return on capital, it just keeps on increasing. And that is very, very useful. You see the trends. That's why we do it on a quarterly basis. As for the DCF, we do this using years. We won't use 2020 and 2021. These are essentially only used for the growth ratios. That is what we want them for, this little number here, the growth. So we're taking every single year and we'll start from the very beginning. In this case, these are not useful for us, so we're going to hide them. And this is sort of the consolidation of everything that we're looking at. So you're going to see, why is this negative? There's a little mistake here, but you're going to see the revenue, you're going to see the EBIT, then you're going to see how this translates into operating cash flow. So what we want is for the EBIT minus the changes in working capital. So if working capital increases, there will be a cash outflow. If working capital decreases, there will be a cash inflow. The logic of that is that receivables, and well, in this case, inventories are negligible, but receivables mean that you will get paid later, and payables mean that you will have to pay later. So we want the number of payables to be up and the number of receivables to be down in order to have the most cash flow possible. What this thing is linking to R31 is a mystery to me. R31 is here. Okay, so these are positive. They should totally be negative. That's the only thing I do. So how to fix this? I just take -1 and I will multiply these by them. And that's pretty much the fix. Beautiful. Now that makes sense. Okay. So we're going to have a certain amount of cash flows that's dependent on exactly those two figures. There are additional elements that you need to take into account. Let's say, for example, taxes. I don't know. There's essentially non-cash one-time deals can also be inputted here. One-time expenses, extraordinary stuff you can include into the cash flow calculations, because what we want with this cash flow is to project into the future. The past doesn't matter so much. So if we have the numbers normalized, that's really what you want to have. So with these figures, what we're getting to is the operating cash flow. And once we get to the operating cash flow, we'll get a certain capex level and we'll extract the free cash flow. Free cash flow is the way we value the company. So the free cash flow that we get for 2026 and beyond is multiplied by a certain discount, because the money in the future is worth, let me show you the formula. Formula text. So the money into the future is worth less. So as we progress into the future, this thing is going to be less. This thing is contingent on essentially one number, and that is WACC. If we make this, let's say 5, the discount rate will be higher. Technically lower in terms of the ultimate value. And that is because we think that the value of money in the future is going to be more than, the higher the WACC, the more we value the stuff in the present. So future money will be lower. The number we usually use is 15% for macro caps. In the case of Red Violet, we're talking about a company that is about 500 million market cap, and that is essentially all cash. So we would essentially not take into account any sort of discount rate for debt. The rate for debt is quite straightforward. You just go into their statements and you look for whatever interest payments they're doing. If their cost of debt is, let's say, if they're paying 5% in interest rate, the cost of debt is essentially 5%. The cost of equity is usually a bit higher, and cost of equity, even though academics want to make it a whole formula and whatnot, it's just your personal opportunity cost. The sum of it is also technically your personal opportunity cost. You just need to weigh, certain costs of debt. Why? Because cost of debt is in itself a way of expressing how good management is and how risky the company is. It's just being evaluated by banks instead of yourself. So you can use that as a proxy. In the case of Red Violet, where it's mostly cash and opportunity costs not that high, you can probably justify 7 or 8% WACC. We will use 10%. Yeah, that was a bit of a long explanation, but that is pretty much it. In the case of G is just terminal growth. So we're assuming perpetual growth into the future of 2%. 2% is just a standard. You can make this 1%, you can make it 3%. I would just keep it at 2%. Again, just the standard. Yep. And as for the other stuff here, well, we have the value, which is just the whatever we're getting in free cash flow times the discount rate. Pretty straightforward. And then we have this complex thing right here, which right now is negative, but that's obviously incorrect, which is the terminal value. And the terminal value is just the last cash flow. So in this case, the value of the cash flow in year 2030 pushed into perpetuity. And the way you push it into perpetuity is by essentially dividing it by the WACC minus growth. Pretty straightforward formula. Again, this is one of those things where the more you do these models or perform these valuations, the better you get at it. But the logic of it or understanding, the methodology behind it is what is important in my opinion. Yeah. Once we get these, the sum of these cash flows and the terminal, let me see if you can see that, by the way. I don't know if you can see the stuff that I'm highlighting. But yeah, those cash flows added up, they will essentially be the enterprise value. That up. That'll be the enterprise value. Again, if we take these and this, 40 million technically, these are in thousands. 41 million is the sum of it. You would subtract the net debt, and that would give you the market cap. So if the net debt is positive, the enterprise value will be lower than the market cap. The market cap is going to essentially be divided by the share count, and then you get the value per share that we're looking at. The share count is obviously something that's variable. If we see a lot of dilution, we would make adjustments here because we have seen, I think it was 40% or something like that. Let's see, shares outstanding in 2019, it was about 10 million, and now they have 14. So that is a lot of dilution in just 5 years, 6 years, technically. Okay, we would account for this. And so when we perform this division, even though the current share count is 14 million, we might want to do something like 16 million because we expect 16 million to be the figure by 2030. That will reduce, obviously, the per share value, but it will make this model more realistic. If we do that, by the way, you would also change the color into blue, just because then you want to reference all of these numbers and you want it to be as easy to understand for your future self as it is for your present self. And sometimes when we look at these back, we may go crazy if things are not properly linked. But yeah, that is what we are doing. So for this 43 million, I don't know where it's coming from, but it is 80-23. 80-23. So this thing right here. Okay. Since net debt is negative, we're adding cash. I'm just making sure of the logic. So we are adding that back into the market cap. Yes, that is correct. Okay. Let me just show you what I'm doing here. Okay. So that is the overall explanation for the model. Now we're going to go into concrete stuff because we want to make this as logical as possible for you guys. Okay, so this company is growing at about 20%. We can assume that rate. In this case, I'm taking the average of these years. We may want to take a bigger average. Why is this going nuts? Okay, because it should say H4 here. Cool. Okay, so let's say, for example, last 4 years. We can also assume 20% here, and that would be fine. It just makes sense. In order to make this super accurate, what we've done in the past and what we continue to do is have an additional tab here that would say something like contracts, and we literally go one by one with the contracts that they have, scheduled for completion in 26 or 2027, and we count the contracts to perform really accurate understanding of the backlog and the revenues in this case for 2026. Because we don't have that, and because we're just doing this for the sake of methodology, we can assume 20%, or we can go back to using the average of the last 4 years, for example. Okay, if we use the average again, this is black. Beautiful. As for EBIT, we can do the same thing, but in this case, as you can see, the EBIT keeps on growing. And that is the whole point of one of these tech companies. The fact that they are unprofitable at the beginning, but they become profitable as time goes by. I would assume a growing EBIT. So as you can see, every year they're increasing it by about 5%. I'd say there's a stabilization at around 25%, and we can do something like this to make it realistic. So this is 25%, and this would be something like this minus this. Let's say this minus this thing multiplied by 3. Let me do this properly. So you need this to do this. And this formula right here is going. This formula right here should be the one that we're posting here. 1 divided by 4. So each year it's going to increase by 3%. Let's apply. I want to divide by the inverse. Okay, so let me actually do the opposite. So this plus the difference between these two is minus these divided by 3 and times this thing right here. Will that give us the correct number? I think so. Excuse my little brain lag. Oh no, we need to divide by 4. Yes, that would be something. You look for scalability in this thing. Okay, does that make sense for you? Okay, this is something realistic. Now, if we change this to 30%, those numbers will also change, which is the whole point of using something like this, because you want to make the scalability, you want it to make sense. Okay, we can use 30%. I think more realistic 25% is going to be sort of the mark. As for working capital, what we're going to do is we're going to understand those needs and use a percentage of revenue. So in this case, we're seeing the change, going from year to year, and we're going to use the last year as, let me show you here, as the way of understanding this. You just divide working capital by the revenue. You get a percentage. That would be 8.5. And we're going to use this into the future. So every year, because this grows, we're going to get a negative working capital. Yep, sure. Yeah. Okay, as for this, we are going to essentially perform the same exercise, but in this case, instead of taking the last year, we're going to take an average. The average in this case works really well because, as you can see, it pretty much is the same. It's around 13% every year. And that I think is going to be consistent into the future. This would be an easy to use assumption. Okay, so we're using the average here and we're using the last year here, just because it will give us a larger number and it's also technically more realistic. If there are one-time things in terms of payables and or receivables, we would totally flag that and perhaps discard some of these numbers. For example, this figure right here may be way too low. Okay, and as you can see, payables are sort of growing. If you skip this year, they're growing slightly, but in a in like a certain pace. In 2024, something was off, and actually, it should be actually something was off, and they had more payables than normal. So this is exactly what I'm referring to, because what we want is to project into the future. We want these figures to be normalized and predictable. Beautiful. And in terms of capex, well, we would now have to go into comments by management and understand what their capex needs are. I would manually edit this figure right here because it does really change a lot of things. For example, if you're going on an international expansion, you have a massive capex boost. If they have to develop certain software because it's becoming obsolete, or if they're going for a new iteration of their existing software, you would manually do this. In this case, we're taking the average, but I want to be more conservative, so I will go for 1%. 1% does make sense. We can make this 5% if you want to, but you can make this as conservative of an assumption as you want. In this case, I will use 1%. Yeah, as you can see, things are shaping up. The only thing that we haven't commented on is the terminal value. How the hell do you calculate this? Super simple. Terminal value is just 2030 plus the terminal growth, in this case 2%. If we change this figure, you'll see that these change. Okay, so we're assuming the exact same thing, 2% growth here for terminal growth, 25% margin. There's no need for depreciation or capex because these technically counter each other. In the long run, capex and depreciation should be equal to each other because you're essentially, like the devaluation of your asset should be zero. In this case, there is a mismatch. Capex usually applies to what's it called? Physical assets, and because these guys are mostly intangible, then your amortization particularly will be a lot higher, and it's not really seen in the maintenance capex side of things. Let me check just in case there's additional. I'm checking the cash flow statement at the moment because we would like to see whether there's incredible spending here. But in this case, and let me share with you what I'm looking at. So in this case, there's other investing activities. I think that we're going to be safer using this. So this is the type of stuff that you only realize once you are performing the model, because capex is so low, and because again capex is more about the physical asset end of things. What we're going to do is we are going to use the other investing activity as our proxy for capex needs. Okay. So we'll copy that. Again. Share screen with you. Beautiful. We will go into the quarterly statements, capex, and we will paste those figures. Then we just took from the other end of things. Beautiful. That makes a lot more sense. 25%. Okay. See how that affects things? Okay. Now we can take an average. This is way more realistic. Average, and we will keep the average. Okay. Yes. Makes sense. Exactly the type of thing that you need to, this is why you have to do 20 of these, because as you do them, you will learn on the fly. And so with this data, I think we have a much more accurate vision of things. Again, if we change the discount to 7%, 7, 8% is realistic for this company. The per share value is going to increase dramatically, but because we are on the conservative end of things, we will use 10%. The translation of these numbers is pretty simple. If we add the cash flows, we will get, as you can see here, 535 million, which is the total enterprise value. If we add the cash back to that, we will get the market cap, which funnily enough is pretty much the exact market cap for the company. Let me show you. So if we read my little ticker, if we look at the current ticker, it's at 41 USD and our valuation claims 41. So, pretty accurate. As I told you, it's not going to pinpoint the exact value, but it will be pretty accurate because the overall process is what matters. And yeah, that is pretty much it. As to when would I purchase one of these things? Well, I would probably purchase my opportunity cost would be something like this. So that pretty much defines the price for me. There are so many other things that you need to understand. Like before you go into price, people are obsessed with this and state the price, but you need to understand the landscape. You need to understand the players. Need to understand how protected the company is against, in other people that want to compete against them, both incumbents and new players. I don't know. Nowadays, it's super popular to go for like word AI and everything. Whether AI actually affects this thing is something you need to understand. But yeah, that pretty much covers the methodology of it. I think it's pretty straightforward. I wouldn't spend too much time on this for every single company that I analyzed. But once you understand it, once you think it's good, you should perform a thorough evaluation. I would go for something like, 50 times 6 would sort of be my barrier. So 50 times 6 is about 300. 300 million is the preliminary valuation that I would have in my head in order to understand one of these companies. But yeah, again, if you start changing these, if you think this thing is going to grow at 30%, then the valuation completely changes. This is, to be honest, just what is already priced into the stock. If you have additional information on revenues, on backlogs, on how margins are going to change over time, then you can create a super accurate model that will give you a distinct view from everyone else. This is just pricing in what everyone knows, at least for Red Violet at the moment, or at least what everyone claims to know. So yeah, let me know if you have any further questions. But other than this, I will leave you be. Let's stop sharing the screen. Yeah, I'll be here for 2 or 3 minutes for questions. Let me know if you have any, and otherwise I will close it out and I will post the recording. Thank you so much, by the way, for being here. And I hope this was useful for you. Okay, it looks like you guys are good to go. So again, I'll post the recording. See you around. Ciao.